Okay, now the seller is looking for the same things in terms of what's deductible on his tax return when he's looking at these escrow statements, and he wants to pull out two things. Again, the same two things the borrower wants to pull out, and that is mortgage interest and real estate taxes. Mortgage interest for the seller is relatively simple. There's no individual line items. It's just simply all buried into this number. Remember, out of the total proceeds the seller is going to get, we're going to deduct what it takes to pay off the loan balance. Well, on the seller's side, the bank automatically calculates what the accrued interest is as of the date of closing. So the interest from that's accrued on this loan balance from the last monthly payment to the date of closing, which is 12/18/2015 in this case, is going to be buried in this number. And you say, well, gee, if I need that number to report on my tax return and it's buried in that number, because remember, this is the accrued interest plus the principal, you're going to say, well, how do I know what to put on my tax return? Fortunately, all the banks send out a Form 1098 at the end of the year, and that Form 1098 will have the total amount of interest you paid to the bank during the year. That's the amount that you will put on your mortgage interest on your Schedule A itemized deductions. So we found the mortgage interest. Look for the Form 1098. It's not here on the escrow statement. Now you want to say, well, what about property taxes? Let's recap on the property taxes. Remember that the seller is going to have the $20,284 deducted from his proceeds before he sees a dime, and that's all closing costs. Okay? So we're looking for property taxes. Up here in the closing cost detail under the seller's portion, or the seller's column, we see what makes up that $20,284, and on line 4 under other costs we see $900 for property taxes to the county. Now, let me explain about the property tax system. It's usually it's a 12-month year, but it's usually a fiscal year, which means it runs from typically July to June. Okay, and the way the county takes payments for those property taxes is typically they'll take a half-year payment installment, or they'll take the whole year. Okay, so when the seller went to sell his property, the people running the title check and everything said, hey, wait a minute, you're behind on your property taxes, and we're going to take that out of your proceeds on the sale, which is what they've done in this number. Because remember this $900, and he says, okay, fine, do that. But since the county only takes a half-year installment as a minimum, it's not going to take anything less. It essentially means that he's paying from, if this was we don't know if this is a half-year installment or if this is the full year, but let's just say for the sake of argument, it's a half-year installment. Typically when people go to sell a home, they're behind perhaps a year unless they've paid the whole year at once. So let's just say that this is a half-year installment. That essentially means that he's paid from July 1st to December 31st, but he's only owned the home from July 1st to December 18th, the date of closing up here. So he says, well, gee, I'm actually overpaying property taxes. I shouldn't have to pay legally the whole 6 months. But that's the way the county works. You only can pay a full half installment. So the escrow people say, you're right, you're due a little bit of refund from 12/19 to 12/31, the time period that the new owner owned the property and you didn't. Okay, that's where this number comes in handy down here. That's the refund of the $900 that he's got coming back for what time period? The time period that he's paid for that he didn't own the property. The same time period that the owner or the new owner owned the property, and it's the same $63.59, but it's going different ways. In other words, on the borrower's side, the 63 is saying, hey, we need this money in order for you to seal this deal. Okay, and that money is due the seller because on his side it's saying this is the amount of money you got coming when you sell this property. You get a reimbursement for the time period of property taxes that you overpaid with the $900, okay, plus your $300,000 selling price. Okay, so at the end of the day, he says, well, what do I deduct on my tax return? Well, for this installment, remember we're assuming this is a half installment. For this installment, you get to deduct what you paid, which is essentially $900 minus what you were reimbursed, the $63.59. So he takes the $900, subtracts $63.59. That's what he gets to deduct on his tax return for that half installment because we were assuming that this was a half-year installment. Okay, and keep in mind that he may have paid another installment earlier on in the year before he ever even made this sale, And of course, if he did that, then he would also want to include that on his income tax return. Okay, and of course the buyer gets to put this amount since he reimbursed the seller for that time period. That's what he gets to include as taxes on his tax return. So we found the mortgage interest buried in this number. Now we've identified the real estate taxes he paid, and that's essentially the $900 on this installment. Paid the $900 minus the 64. That's going to, those two items are going to be on Schedule A. We've taken care of that. So you say, well, okay, well, gee, that's closing costs of $20,284. We were just talking about the county taxes, which is a relatively small amount, $900. That makes up the total closing costs that he paid in the closing. So you say, well, isn't any of this deductible? Well, not typically right away. It is in the sense that the rest of this $20,284, okay, not the closing, not the property taxes, which we've already taken care of. You take the $20,284, subtract 900, you're going to get $19,384. $19,384, which is the remaining amount of this number of closing costs, gets subtracted from the selling price, okay, and that ends up being the selling price that you report on your tax return. So in effect, it makes your gain on the sale lower, and that's where that's taken into account. So you don't get an immediate deduction, but essentially, if you've got a gain on the property, it still helps you out. So that takes care on the seller's side of the mortgage interest, which is buried in this number, the real estate taxes, which we pulled out. We subtracted the amount that he was reimbursed, and it takes care of the selling expenses that are essentially deducted from the sales proceeds to calculate the gain on the sale. Now we've discussed the tax ramifications from the seller's point of view, and that should make that clear. If there's any other questions or issues you have on this form, you can simply send some comments, and I'll answer them, of course, through this YouTube video. Hope that makes it clearer for you. Hope this has been helpful for you, and you can feel free to contact me if you have any questions. Thank you.